Welcome to the SafeSimpleSound podcast. This is the space where we believe financial planning shouldn't be a source of anxiety, but a source of strength. We are dedicated to the idea that your financial life doesn't have to be a series of stressful trade-offs. Instead, through our S3 approach, we create both-and solutions for the contradictions families face every day. I'm your host, speaking with you today, drawing from our team's chartered financial consultant background and our extensive development of the S3 framework. We are here to bring you the steady, reliable wisdom of the tortoise in a world that is often too obsessed with the erratic speed of the hare. In today's episode, we are exploring a fundamental tension that sits at the heart of every household budget: the price of protection. This is a topic we recently explored in our written blog series because it touches on a universal frustration. We all want protection from the absolute worst-case scenarios, those financial catastrophes that keep us up at night. But we also demand premiums that fit comfortably into our monthly cash flow. Usually, the financial industry presents this to you as an either-or choice. They tell you that you can have comprehensive sleep-at-night coverage, or you can have affordable premiums. They suggest you can't have both. Through our SafeSimpleSound practice, we reject that trade-off. We believe that by understanding the principles of measurability and economic feasibility, you can find a both-and solution. You can have robust protection against ruin and a sustainable cash flow that allows you to enjoy your life today. Whether you are just starting to build your safety net or you are approaching retirement and looking to preserve what you've built, this episode will give you the tools to structure your insurance not as a monthly burden, but as a strategic asset. We're going to look at the S3 approach to risk transfer, and specifically how to stop overinsuring the small things so you can properly protect the big things. So take a deep breath. Let's slow down and look at the sound mechanics of how protection actually works. Let's begin by establishing the challenge. In our practice, we often observe a common pattern when families review their insurance declarations pages. There is a feeling of helplessness regarding the cost. You look at the premium, you look at the coverage, and you feel like you are at the mercy of a pricing algorithm that you don't understand. The blog post this episode is based on serves as the second part of our series on risk transfer. Previously, we discussed the law of large numbers, the math that makes insurance possible. But today, we are looking at the economics of the premium. The SafeSimpleSound framework is built on three pillars: safe, simple, and sound. When we apply these to insurance, we have to look at what makes a risk actually insurable. It's not magic, it's strict criteria. The first principle we need to discuss is measurability. From a simple perspective, this means defining the definite. For a risk to be transferable to an insurance company, the loss must be determinable and measurable. This seems straightforward, but it is the guardian of a sound economic system. To be measurable, a loss needs three things. 1, time, when did it happen? 2, place, where did it happen? 3, amount, what is the specific dollar value of the loss? Imagine if insurance companies tried to insure vague feelings. If you could file a claim saying, "I feel like my reputation was damaged last week," or "I feel less financially secure than I did yesterday," the system would collapse. Why? Because the insurer cannot price that accurately. If they can't measure the loss, they can't calculate the premium. To be safe from their perspective, they would have to overcharge everyone to cover the uncertainty. This gives us a new perspective on the fine print. In our S3 framework, we don't view specific limits and deductibles as gotchas or tricks designed to deny you money. Instead, we view them as the tools that make losses measurable. They define exactly what the insurer is on the hook for. This clarity is what keeps the system stable and reliable for all of us. Now, let's move to a more complex challenge, the Catastrophe Paradox. This aligns with the reality that while we want safety, true safety requires systemic stability. The law of large numbers, which we discussed in the previous episode, relies on risks being independent. Think about car accidents. If I have a fender bender in my driveway, it doesn't physically cause you to crash your car 3 states away. These events are independent. This allows the insurer to predict how many crashes will happen in a year and price the premium accordingly. But catastrophic risks violate this rule. We are talking about events like massive floods, wars, or nuclear accidents. In these scenarios, the independence of risk disappears. If a major flood hits a river town, everyone in that neighborhood claims a total loss at the exact same time. From a SafeSimpleSound perspective, this concentration of loss threatens the solvency of the insurance company. If the company goes bankrupt because of one flood, they can't pay anyone's claim. That is the opposite of safe. So here's the question we pose in our framework. How do we insure our homes against disasters without bankrupting the system? How do we get that both-and solution of local protection and systemic safety? The answer lies in a concept called reinsurance. To put it in simple terms, your insurance company buys its own insurance. They transfer that concentrated risk to a global reinsurance market. This spreads the risk of a local hurricane in Florida across capital markets in London, Zurich, and Bermuda. This is a beautiful example of a solution. It allows your local carrier to offer you protection against a disaster without collapsing under the weight of it. It creates a safety net beneath the safety net. It is the ultimate both-and. You get specific, local protection backed by global, diversified strength. This leads us to the final and perhaps most critical principle for your personal budget: economic feasibility. In our practice, we often remind families that just because a risk can be insured doesn't mean it should be insured. For a premium to be sound, the chance of loss must be low enough that the premium is affordable. Let's use an extreme example to illustrate this. Imagine you own a home on an eroding cliff. Geologists tell you there is a 90% chance the house will fall into the ocean this year. Can you insure that house? Technically, an actuary could price it. But if the house is worth $500,000 and there is a 90% chance of a total loss, the fair premium would be roughly $450,000 for 1 year of coverage. That isn't insurance. That is prepayment. It is not economically feasible. To keep premiums sound, meaning affordable within your monthly budget, we must focus insurance on the sweet spot. We want to insure events that have a low frequency. They rarely happen, but a high severity if they do happen. They are ruinous. When we try to insure things that are high frequency and low severity, we break the economic feasibility. We end up trading dollars with the insurance company and paying them a fee for the privilege. This sets the stage for our core S3 strategy: retain the small, transfer the large. We've established the principles: measurability, the challenge of catastrophes, and economic feasibility. Now we want to look at how this applies to your real-world financial life. In our SafeSimpleSound practice, we often see families trapped in an either-or mindset regarding their deductibles and coverage limits. They believe that a good insurance policy is one that pays for everything, even the small scrapes and dents. But this approach often leads to bloated premiums that choke off their ability to save and invest. To illustrate how our framework resolves this, let me share a hypothetical scenario. Please note, the following story about the Miller family is a hypothetical scenario created for educational purposes. It is designed to illustrate the patterns we observe when families apply S3 thinking to risk management. It does not represent a specific client, but rather a composite of common financial situations. Let's picture a fictional couple, Mark and Sarah Miller. They are in their mid-40s, have 2 teenage drivers in the household, and they are diligent about being safe. When the Millers first set up their insurance years ago, they wanted to feel protected. So they selected policies with very low deductibles. They have a $250 deductible on their auto collision coverage and a $500 deductible on their homeowner's policy. Their logic was, if something happens, we don't want to have to come up with a lot of cash. However, as their teenagers started driving, their premiums skyrocketed. They are now paying a small fortune every month to the insurance company. They feel squeezed. They are protected against small things, yes. If a shopping cart dents the car, they only pay $250. But the cost of that privilege is eating away at their retirement savings. Even worse, despite these high premiums, the Millers have a gap in their soundness. They do not have an umbrella policy, that extra layer of liability protection, because they feel they can't afford any more insurance. Now, let's apply the S3 framework to the Millers' situation. In this hypothetical journey, the Millers sit down to review their strategy. We look at the principle of economic feasibility. We realize they are violating the rule of the sweet spot. They are paying high premiums to transfer small, manageable risks, the $250 dent, to the insurance company. This is an expensive way to manage money. It's like hiring a bodyguard to swat a fly. So the Millers decide to make a shift. They decide to retain the small so they can transfer the large. Here's what they do. 1. They raise their auto deductibles from $250 to $1,000 or perhaps even $2,500. 2. They raise their home deductible from $500 to $2,500. By doing this, they are telling the insurance company, we will handle the minor bumps and bruises. We will retain that risk. The immediate result in our scenario, their monthly premiums drop significantly. The insurance company charges much less because they know they won't be processing small, frequent claims. But the Millers don't just pocket that savings and spend it on dinner. That wouldn't be sound. They take a portion of those savings and purchase a $2 million umbrella liability policy. While this story is fictional, it demonstrates exactly how the SafeSimpleSound framework operates in the real world. Let's look at the before and after through our lens. Before, the Millers were safe from a $300 repair bill, but they were vulnerable to a $2 million lawsuit that could wipe out their life savings. Their strategy was penny-wise and pound-foolish. They were insuring high-frequency, low-severity events. After, by raising their deductibles, they accepted a small amount of risk they can manage with their emergency fund. In exchange, they gained protection against the truly catastrophic event, the lawsuit or major disaster that they could never handle on their own. They moved from an either-or high premiums or poor coverage to a both-and. They lowered their monthly fixed costs and increased their protection against ruin. This aligns perfectly with the requirement of economic feasibility. By removing the high-frequency small claims from the system, the premium becomes efficient. It becomes feasible. Through our practice, we've observed that this psychological shift, from trying to insure everything to strategically insuring the catastrophic, is often the turning point for a family's financial confidence. It moves them from a defensive posture, fearing every small accident, to an empowered posture, knowing the big structural risks are handled. Whether you are facing this exact scenario with teenage drivers, or you're simply looking at your homeowner's bill, wondering why it's so high, the principle remains the same. The goal of insurance is not to maintain your car or house. The goal of insurance is to protect your household's net worth from a fatal blow. By retaining the small risks, you regain control over your cash flow. By transferring the large risks, you secure your future. That is what we mean by safe, simple, and sound. As we begin to wrap up today's episode, let's bring these concepts back to the center of your financial table. We started with a contradiction, the desire for total protection versus the reality of a limited budget. We explored the foundations that solve this. Measurability, understanding that insurance requires specific definitions of time, place, and amount to function safely. The Catastrophe Paradox, recognizing that while we need protection from disasters, the system relies on things like reinsurance to handle those correlated risks without collapsing. Economic feasibility, the realization that we cannot and should not insure risks that are highly likely to happen. And most importantly, we looked at the S3 strategy, retain the small, transfer the large. This is the actionable takeaway for your family. Ask yourself, am I paying a premium for the insurance company to manage risks that I could handle myself? Do I have a $250 deductible that is costing me $500 a year in extra premiums? From a SafeSimpleSound perspective, increasing your deductible is not risky, provided you have an emergency fund. It is a strategic reallocation of resources. It allows you to redirect those premium dollars toward the risks that actually threaten your financial life, like the need for an umbrella policy or better catastrophic coverage. Navigating these trade-offs requires more than intuition. It requires a framework. This episode draws from our recent blog post, The Price of Protection, which you can find at SafeSimpleSound.com. In that post and here in our practice, we offer 2 specific tools to help you apply these principles. First, we have the Sustainable Premium Strategy Guide. Through our S3 framework development, we created this resource to help you learn how to balance your deductibles and limits. It's designed to help you create a premium structure that you can sustain for decades, ensuring you never drop coverage when you need it most because of a cash crunch. Second, we offer the Fortuitous Loss Decision Matrix. If you are not sure if a specific risk, like pet insurance or an extended warranty on a dishwasher, should be insured or just managed, this matrix is for you. It uses a simple 4-quadrant grid to help you decide when to transfer, retain, or avoid a risk based on frequency and severity. If today's S3 insights resonate with your family's situation, we invite you to explore what financial planning could look like through our SafeSimpleSound practice. We love helping families turn these contradictions into clarity. However, even if you never choose to engage with our practice formally, we hope this episode has equipped you with a new capability. We want you to look at your next insurance renewal, not with confusion, but with the steady confidence of the tortoise. You now possess the framework to verify if your protection is truly sound. Thank you for listening to the Safe Simple Sound podcast. Remember, financial wisdom isn't about moving fast. It's about moving in the right direction with the right protection in place. Until next time, keep it safe, keep it simple, and keep it sound.